Every time you write a check, your bank loses money, not a little. One widely cited study puts the all-in cost of processing a single paper check, labor, bank fees, printing, postage, at around $4 per transaction, while the average electronic payment costs roughly 28 cents. That's not a rounding error. That's the difference between a transaction that makes the bank money and one that quietly bleeds it, repeated millions of times a day, every single day, for over a century. So next time you walk into your branch and ask for a checkbook, and the teller gives you that look, the slight hesitation, the "Are you sure you don't just want the app?" energy. That's not customer service. That's a bank that's been trying to get you off paper for over a decade and is too polite to say so out loud. Let's get into why. Reason 1, a check has to survive a whole journey. A check isn't really a transaction. It's a physical object that has to go on a trip. Someone receives it. Someone scans it. Someone verifies the signature, checks the funds are actually there, transmits it to the other bank, and clears it through a system that, even now, even with all the automation, still needs human eyes on the back end watching for fraud and mismatched signatures. A tap of a card does all of that in about 2 seconds, automatically, with nobody touching anything. This wasn't always handled this badly. There's actually a fascinating piece of history buried in why checks even became digital at all. The push toward electronic check processing traces directly back to September 11th, 2001, when the grounding of all air travel disrupted the entire system of physically flying paper checks across the country, creating a massive backlog that forced the Federal Reserve into emergency intervention. Checks used to literally fly on planes between banks to clear, and when planes stopped flying, the banking system nearly seized up. That crisis is what pushed Congress to pass the Check Clearing for the 21st Century Act in 2003, which let banks scan a check into a digital image called a substitute check and treat that image as the legal equivalent of the original, eliminating the need to physically move the paper at all. The results were almost immediate at scale. The Federal Reserve reported a greater than 70% reduction in per-item check processing costs after the shift to electronic collection, saving the U.S. payment system an estimated $1, $16 billion annually by 2010. That's not a small efficiency gain. That's an entire industry admitting, in its own numbers, just how wasteful the old paper-flying system actually was. And yet, even with all that digitization, even with images replacing physical paper almost everywhere, checks are still dramatically more expensive to process than a card swipe or a bank transfer. The paper got faster. It never got cheap. Reason 2. A check is a fraud magnet with your name on it. Think about what a check actually is. A slip of paper with your account number, your bank's routing number, and your signature, sitting in a mailbox, a desk drawer, sometimes a trash can for however long it takes someone to find it. Forged signatures. Altered amounts. Washing, where someone chemically erases the original ink and rewrites the entire check from scratch. None of that requires a hacker. It requires a pen, a stolen envelope, and about 10 minutes. A card, meanwhile, comes loaded with encryption, real-time fraud detection algorithms, and a bank's ability to freeze it the instant something looks wrong. A check has almost none of that built in. Once it leaves your hand, it's out of the bank's control completely. And when something goes wrong, the bank often eats that cost, not you. This isn't a fringe risk either. The Government Accountability Office found that check imaging under Check 21 had a largely neutral or minimal effect on overall fraud losses, meaning digitizing the check didn't actually solve the fraud problem baked into the format itself. The image moves faster. The vulnerability comes along for the ride. Reason 3. A check tells the bank almost nothing about you. This one's less obvious, and it might be the actual reason banks have mostly stopped caring whether you switch. Every card swipe generates data. Where you spent, what category, what time of day, how often. That data feeds straight into the systems that decide what loan to offer you next, how to price it, and what product to push in front of you. That's not hypothetical. It's literally how your bank knows to dangle a car loan offer at you right after 3 straight months of dealership and auto parts spending shows up on your card statement. The algorithm doesn't need to guess. It just reads the receipts. A check gives the bank none of that. It just says money moved from one account to another. No category, no merchant detail, no behavioral signal to build a profile from. In a world where your spending data is worth nearly as much to a bank as the money itself, a payment method that produces zero data has almost no upside left for them. Reason. 4. The one advantage. Checks used to have is gone. Decades ago, checks had a quiet edge for banks called float. The lag between you depositing a check and it actually clearing, during which the bank could effectively use that money before officially handing it over to you. It wasn't huge, but for an institution processing billions of checks a year, it added up. Instant and same-day digital settlement has mostly killed that advantage for the bank. So checks went from annoying, but at least slightly profitable on the side, to annoying and a pure cost center, with nothing left to offset the expense on the bank's end of the ledger. Funny enough, that same float still quietly works in the opposite direction for some businesses. A check written on Friday won't clear until Monday, which can buy a small business with a tight cash cycle an extra day or two of breathing room. The bank isn't benefiting from that delay anymore. The business writing the check is, which is a strange little inversion. The one feature that survived is now working against the side that used to profit from it. So why do checks still exist? At all. If checks are this expensive, this fraud-prone, and this data-poor for banks, why haven't they just disappeared? 3 real reasons, and none of them are because banks want them to. First, regulation. Most banks are still legally required to offer and honor checks regardless of their internal preference. They don't get to simply opt out. Second, certain transactions, real estate closings, large business-to-business payments, legal settlements, still lean on checks because the paper trail and verification process are baked into decades of legal infrastructure that doesn't shift overnight, even when everyone involved would technically prefer something faster. Third, and this is the number that genuinely surprised me when I looked it up, small businesses are nowhere close to abandoning checks. Nearly 80% of very small firms with revenue under $1 million still use checks for business payments, and small firms lead every single segment at 83%. Businesses are now actually writing more checks than consumers, 7 billion versus 2 billion, and account for 76% of total check value, with an average business check size of $3,601, nearly 3 times the average consumer check. That's not a dying habit clinging on at the margins. That's load-bearing financial infrastructure for an enormous slice of the small business economy. Part of the reason is genuinely practical. Checks carry remittance data with them, invoice numbers, purchase order references that make bookkeeping easier for a small operation without a full accounting platform. And many small business owners simply aren't going to invest in payroll software to pay 3 employees when writing a check works fine. Cut that lifeline off too fast, and the backlash isn't worth it for a bank. Not yet. Anyway, the quiet trade-off underneath all of this. Here's what makes this whole situation more interesting than a simple banks bad, checks good story. The inefficiency that costs banks money is, in a lot of cases, exactly the same inefficiency that benefits the small business or individual writing the check. The float that hurts the bank's processing efficiency gives the small business breathing room on a Friday paycheck. The lack of granular data that makes checks worthless to a bank's marketing algorithm is the same lack of data that keeps your rent payment from being quietly logged, categorized, and used to model your financial behavior. The slow manual verification process that makes checks expensive to clear is also what gives a consumer a tangible paper trail and, in some cases, an extra layer of dispute protection that purely digital transfers don't always offer in the same way. None of this means checks are secretly the superior technology. They're objectively slower, more fraud-prone, and more expensive at scale, but the reasons banks want you off them aren't purely about making your life better. They're about shifting the entire payment ecosystem toward whatever rail is cheapest for the bank to run and richest in data for the bank to mine. Sometimes that shift genuinely helps you too. Sometimes it just quietly transfers a little bit of float, privacy, and control away from you and toward the institution holding your account. The bigger pattern. This was never really a story about checks. It's a story about how payment methods survive or disappear inside modern banking. And that survival has never been primarily about what's most convenient for you. It's about what's cheapest to process, lowest risk to hold, and richest in data to collect. Cash is on roughly the same slow path for almost identical reasons. Fewer ATMs, more fees for withdrawals, more friction every single time you try to opt out of the digital rail the system would prefer you stay on. The fees creeping in, the friction at the counter, the gentle nudge every time you open the app and see a banner asking if you'd like to go paperless. None of it is really about modernizing your life for your benefit. It's a financial system steadily steering $30 trillion a year of payments toward whatever path costs it the least and tells it the most. The check in your drawer isn't outdated because it stopped working. It's inconvenient because the people running the system you bank with decided slowly and deliberately that it should be.